Okay, in this chapter, we're looking still at our accounting equations, assets equal liabilities plus equity. But also in this chapter, we're looking at what we call debits and credits. Okay, let's talk about assets and how debits and credits relate to assets. First of all, some examples of assets are cash, accounts receivable, supplies, and so forth. Each one of these accounts has its own balance, okay? We have a cash balance, we have an accounts receivable balance. Well, I'm gonna write something called a T account here under cash, T account under accounts receivable. Now, the left side is the debit side, and the right side is credit. That's all debits and credits mean. To the left is debit, to the right is credit. So, and debits are often abbreviated DR, and credits CR. Okay, so there we've got a T account for cash. Now, if cash had a $100 balance, and it was a positive balance, it would be a debit. Okay, that sounds confusing to most students. You just have to learn that. Debits increase assets, okay? So the debit would increase cash, and a debit would also increase accounts receivable. Credits decrease these accounts, okay? When you're looking at liabilities, the most common liability is accounts payable, notes payable. Well, remember, debits and credits just mean to the left, to the right. A credit increases accounts payable. A credit increases accounts payable. Now we've got our equity accounts where we have our capital stock, our retained earnings. Well, hold on, let me back up here. Capital stock, we have dividends, we have revenues, and we have expenses. Now these are a little bit different, okay? Now, remember in our accounting equation, assets are on one side, liabilities and equity on the other side. Everything has to balance in accounting. Everything must balance. So if these assets increase with debits, then these accounts must increase with credits. So capital stock and revenue increase equity, oops, I just made a mistake, increase equity, so they have to have a credit balance, okay? Now, dividends and expenses, these are actually reductions of equity. So they have a debit balance on this side, on the right, left side, I'm sorry. I hope I haven't been saying that backwards. Debits to the left, credits to the right. Debits to the left, credits to the right. And then over here, credits increase liabilities. And under equity, equity increases with the credit, okay? And these are the increasing accounts, capital, stock, and revenue. Decreasing accounts are dividends and expenses. So dividends and expenses would increase with debits. So basically, accounts that increase with debits are assets, okay, dividends, and expenses. There are your three accounts that increase with debits. So then basically, all the other accounts increase with credits. So your liabilities, capital stock, and revenue increase with credits, okay? Now, let's take a look at this in a different format. This is called the T account format, and it's a very simple, fast way to look at accounts. When accountants are analyzing transactions, oftentimes they'll do T accounts. If we're doing our formal books, we don't do T accounts. In our formal books, we do what we call journal entries. So a journal entry, let's say that our owner is contributing, putting $10,000 into the business. Okay, our owner's putting $10,000 into the business. Well, what we would do is we would say, well, cash is increasing. So I said it was $10,000, so there's $10,000 right there. And then capital stock is increasing. Well, capital stock increases with a credit. So then we would credit capital stock. And this here is the official journal entry, okay? You put cash and then 10,000. This would be a debit column. This would be a credit column. And then capital stock, 10,000 credit. So here's a journal entry. This would be a formal journal entry in our books, okay? And they're in chronological order. So we'd have whatever the next journal entry is, we just post it. And we do it this way because accountants can quickly see our entry is right. Debits equal credits. Every transaction has to be in balance. And now at this chapter, when I say in balance, I'm talking about debits must equal credits. So that's what's happening here. Our next journal entry, let's say that we sold, we did some consulting work on credit, okay, for $1,000. So somebody owes us $1,000, we've done the work, so we have accounts receivable 1,000, and then we have our consulting revenue. Accounts receivable is an asset, increases with the debit, so there's 1,000, and then revenue increases with a credit, so we would credit revenue. So every transaction is going to work this way. You're going to have to look at the chapter, look at these transactions and see that they're working, that they're in balance, understand them inside and out. I think you can see the importance now of understanding chapter 1 before moving on to chapter 2. If you don't understand chapter 1, you're not going to get chapter 2. You've got to get a good understanding of chapter 1 first. So good luck with this part of the chapter.